In the previous lesson, you learned how to backtest your model. In this section, we will list some qualitative ways to improve your model. Some of these ways will involve adjusting for external factors and understanding how this impacts the profitability of your trades. We will identify external factors that can affect stock prices and help you understand how each type of factor affects trade profitability. This will help you include external factors in your models. We will look at a range of external factors and events, including time and day of week, related markets, economic events, and update to market indices. To start, let's look at time and day specific effects. The first thing you look at are the time of day effects. Do you tend to make profits only in the first hour the stock market is open? Do you tend to have profitable trades only in the last 30 minutes the market is open? Is there a great proportion of daily volume that trades at the open and close? You may realize that your model may not work the rest of the day when trading may be lighter. You should produce a graph that illustrates all of your profitable trades broken down by the hour of the day. If you see any differences from one plot to another, then you can qualitatively state that there is a time of day effect in place. Knowing this, you may choose to filter your data so that you only backtest on those points at the most profitable times of the day. In other words, you avoid trying to force a one-size-fits-all model. That means that you may backtest parameters for certain parts of the day only. For other parts, you may choose not to run a model, or perhaps you backtest that part separately. This is the main idea behind most of the suggestions that will follow. When you understand the details of your profits, you can understand when and how your model works. Next, you can examine day of the week effects. In many stocks, there may be higher volume or higher volatility on some weekdays than others. That means you may be more likely to trade if your models require some amount of volatility. Perhaps you choose not to use certain weekdays which have historically low volatility. The prices and returns of the stocks in your pair can also be affected by trading in related markets such as derivatives. For example, let's consider options markets. Once a month, typically on the third Friday of the month, the options on equities expire. Is there more volatility on the day options expire? In an annual backtest, there would be 12 such days. Do we detect any difference between trades occurring on option expiration days versus trades taken from other days? Some traders decide not to trade these days due to higher volatility in the markets. Other traders may make their living just trading around these days. Next, we'll look at how the periodic release of macroeconomic and company-specific information can affect your trading. You can examine economic events. In our first lesson, you learned that economic events could be part of the rules that help us to initiate a trade. Likewise, when you examine your results, you should see if they are influenced in any way by key economic reports. If you decide to trade when an unemployment number is released, you may be in for a surprise. Markets can move very rapidly in the minutes leading up to and immediately following such an important economic indicator. Any report that has a surprise element can create a frenzied trading environment that can push an otherwise successful strategy right to its stop loss level. You also need to anticipate quarterly earnings announcements. Earnings announcements usually have a much bigger impact on the affected stock's price than announcements of general economic indicators. Trading volume and volatility are much higher before and after announcements as traders and asset managers reposition their portfolios. If you decide to carry a position through an announcement, you must make sure that your stop loss orders anticipate potentially much higher volatility. Updates to market indices can affect your trade if one of the stocks in your pair is added or dropped from a market index. A market index comprises companies that meet certain criteria. Periodically, these criteria upgrade certain companies to be added to the index. Also, you'll see that certain companies are deleted from the index. This can have an effect on their stock price. Imagine a fund manager has an investment mandate to track that index. If the stock is no longer in the index, the fund manager is likely going to sell that stock. The combined effect of this throughout the market can be enormous. Deleted stocks from indices tend to have big drops in price. We've identified some events that are periodic, like the hour of the day, day of the week, monthly economic indicators, and quarterly earnings announcements. We've also identified less frequent events like index additions and deletions. The important point is the same for both types of events. You need to understand if and how your trading results will be influenced by these events.